So thanks so much, Filippo and Frederick, on the wonderful venture building session. The next topic will be venture capital in Southeast Asia. This region is home to some of the more exciting emerging markets in the world, particularly due to the growth of venture capital funding and its ability to transform these economies. So 3 of the 4 firms that'll be joining us were formed in the past couple of years, but all of them have already been involved in some pretty exciting large deals. So without further ado, I'll introduce you to our group of speakers, which is Dmitry Levit, a general partner at Cento Ventures, which is a Singapore-based Series A that focuses on underinvest emerging digital markets. Victor Chua, founding and managing partner of Vynn Capital, a Malaysia-based VC that focuses on travel, property, and logistics startups. Scott Krivokopich, who is the managing partner at 1982 Ventures, based here in Singapore, that focuses on early stage fintech. And Nicholas Cator, who's the managing partner at Venturi Partners, a growth stage Singapore-based venture capital firm focused on Southeast Asia and South Asia, including India. So I think to start out, I'll just ask each one of you to introduce yourself, tell everyone a bit about your work and what your firm's investment thesis is, and also just what made you choose Singapore, what made you come here and get involved in VC, and just a little bit about your journey. So why don't we start out with Scott from 1982 Ventures?
Sure. So maybe starting from 1982 Ventures, what we do, we're a seed stage VC fund focused exclusively on fintech in emerging Asia, which is mostly Southeast Asia, but also we look at Pakistan and Bangladesh as well. We're based here in Singapore. The firm is my partner Hurston and myself with some 1 or 2 juniors. And Hurston and I have worked together for about 4 years now. We previously were doing investments at another company, and at the beginning of the year we launched 1982 Ventures on our own. Again, so it's seed stage, it's fintech. My background, I guess we can go into this a little bit later, but how do you get into venture? I think everyone kind of has their own path, unless you're maybe in Silicon Valley. There's probably some larger firms that recruit people right out of school, but I came to Singapore. I've been in Singapore for about 4.5 years. Before that, I was in Shanghai. I started a business with a partner doing corporate finance advisory. So my background is really very finance, which I think you see a lot of in Southeast Asia. It's not necessarily the best background to have for venture capital, but a lot of us kind of get there that way. But I was doing mid-market corporate finance stuff in Shanghai, and before that, I did a lot of stuff with credit and lending. So I started my career working with credit derivatives. I've done that all the way sort of to working at Grameen Bank for about 1.5 months in Bangladesh, working with microfinance. So that's a bit about my background. I think we can start to talk about more of these topics maybe once everyone's introduced themselves.
Sure. Yeah, that was great. How about Dmitry?
Certainly. Good to see everybody. Started Cento Ventures together with a few co-conspirators back in 2011 in Seattle from July of 2006. Got into venture by going to Yahoo right after graduation, black and purple, or yellow and red, whichever the colors were, and then followed my event boss into a venture firm in Vietnam, and then started this thing. Series A is our cornerstone strategy, more specifically Southeast Asia regional expansion Series A, but we also dabble in later stage in Series C and Series D on occasion. And the heavy accent you're hearing is Russian, of course. 15 years in Singapore hasn't expunged that. And I'll pause for my fellow panelists' introductions, and then we'll get deeper into it.
Sure. Why don't you go ahead, Nick or Nicholas?
Yeah, Nick, thanks. Great to meet everyone. Also based here in Singapore. I moved out here about 5 years ago from Belgium to open the office for Invest, which is a family-owned growth consumer investor. Left them about a year ago to start Venturi Partners. And so our focus is on growth investments in the consumer space in India and Southeast Asia, so Series B to Series D investments. And then, of course, we have lots of relationship with all of the different venture and more early stage funds in the region.
Great, and I guess
What are you having?
Just a bit of pasta.
Very Italian, man. Yeah.
Hello.
Is Victor there?
Yes, I'm here. Sorry,
Great, perfect.
Yes, just wanted to unmute myself. Good evening, everyone. First of all, thanks for having me here. Just a bit of personal background. I'm sorry that I have to bore Dmitry with a bit more introduction since he really knows me. I started venture about 7 years ago with a Malaysian government-owned VC fund called MavCap. Subsequently, I went over to Venturi Partners, which is a Shanghai-based VC fund to look after the early stage investment strategy for Gobi. And Vynn Capital is my own platform that I launched early 2018. As a firm, we look at seed to Series A investments. We look at Southeast Asia as a whole. Obviously, because of the fact that we are based in Malaysia, there's more work here, but that doesn't mean that we're not doing anything in Singapore. In fact, Singapore, we have a desk in Singapore as well that's looking after some of the opportunities for our portfolio companies to expand into Singapore. Like what I think earlier Nick or someone mentioned, we are more sector focused, look mainly into travel, mobility, prop tech, FMCG related, as well as femtech or female technology. So these are the kind of things that we look at. I'm sure we can talk more later on as well. Yeah, so thanks.
Great. It was wonderful to get to know all of you and learn a bit more about what you do. I guess I'll move right to the elephant in the room and ask how COVID has changed your business for good or for bad. What's been the most interesting trend you've seen this year, and what excites you most going forward? And we can go in the same order. So why don't we start with Nick for this question? Sorry, I mean, Scott. Go ahead, Scott.
Well, so for us, we're a new fund. We're fundraising. So anybody who's fundraising right now knows it's pretty tough. Maybe I guess, based on the audience here, it's a dirty little secret that VCs have to fundraise too. Oftentimes it's hard. It's as hard, or sometimes even a bit harder than raising for a startup, but it's not too different. So everything that if you're working with a startup or thinking about that goes through, VCs are going through the same thing. So early in the year, early mid-year, I think there was a lot of questions. For a small fund like us, we raise a lot from family offices and sort of high net worth in that category. And so those businesses, most of the family offices, they may not say this, but a lot of them quit investing in probably Q2. Especially in this region, a lot of family offices have pretty big real estate holdings. They might own hotels, they might own a lot of manufacturing and things like that. And so they were generally less concerned about making a VC investment that was maybe, I don't know, $1 million or a few $1 million, and shoring up their balance sheets for their main businesses, which were worth billions of dollars. So just the sort of attention span, I think, was shocked a little bit. That said, we've kept on moving along. We've made some interesting investments throughout the sort of, I don't know if you call it a crisis or the pandemic, and fintech has been largely, well, I wouldn't say largely, but fintech has been in some parts of it quite a bit of a winner. So digital payments has been really outpacing, I'd say, general overall growth. Digital banking has been a really hot space this last year, and anything digitizing sort of stead businesses. So if you look at a big, Fortune 500 size company, or even a little bit smaller than that, their R&D budgets have really been shaken this last year. And every business manager is talking about how to COVID-proof their business, whether it's allowing to serve customers digitally, or just making things more resilient, which often involves digital. So those are some of the sort of broad themes that we've seen this year.
Definitely.
Would that be me next?
Yeah, go ahead.
Sure. Rather than pleasant year, I have to say, had to cease all investment activity for 6 months and throw all the resources we had and then some at portfolio support, which is a pretty underrated but extremely important venture capital function. Most of the instability surprisingly came not from the market or from the companies. Everybody adjusted their business model. Everybody had some wobbles in product market fit, but everybody kind of got into this quickly. Most of the instability came actually from co-investors, from neighbors and cap tables, as Scott alluded. Family offices are hurting, especially local ones. Foreign corporates that previously said Southeast Asia suddenly realized that things at home require more attention. So a lot of time this year was spent just being the dampener, as it were, of bad news from co-investors to portfolio companies. People trying to sell their stakes, people panicking, people pushing for strange new directions and strategy. More or less calmed down, I think, in the last couple of months. So we're back to looking at targets. And in the meantime, externally, I'm not sure to which extent it excites me, but it certainly fascinates me. Finally, regulators across Southeast Asia are starting to pay attention to digital ecosystem. Some because it lets them look good in the next election because everything else looks bad. Sometimes because they're under misbegotten impression that they can pump subsidies to their populations through digital wallets. Sometimes it's because they have a few $100 million in the budget and they just want to spend it before they're kicked out of power. But some meaningful changes to regulation too, from payments to logistics, Omnibus Act that was mentioned in the previous panel. So acceleration of regulatory decision-making in Southeast Asia has been palpable. Nobody is letting this particular crisis go to waste. I'll stop here, and Victor, I'm sure after your part, we will regroup on what's been happening in Malaysia.
Should Nick start first or myself?
Yeah, why don't you go ahead and you can respond to Dmitry.
Sure.
We'll have Nick close it out.
Yeah, sure. I mean, it's like aligned with what Dmitry has mentioned. You know, governments are definitely paying a lot more attention. Even back at home over here in Malaysia, we had a series of, you know, fun exercises where I'm sure, you know, most of the gentlemen, the folks here are aware of it. Government of Malaysia is continuously trying to bring foreign VCs into Malaysia as well. So in that sense, there's more activity. But of course, like what Dmitry mentioned, it could be an exercise of getting the votes, getting the popular vote for the next upcoming election as well. So there's still a lot of work that needs to be done in making this a sustainable effort coming from the government and you know, making sure that this impact would be a long-lasting one. So that's one part. But going into the deals, the portfolio companies itself, pros and cons. The good thing is that most companies, most governments are looking at digitalization. So that makes the life of our portfolio companies much better. But having said that, because of the fact that there hasn't been sufficient investment into the infrastructure, it becomes a new headache. Startups are having capacity issues because there's just not enough infrastructure, there's not enough talent, there's not enough resources that could help them to scale. And it could become a bad thing eventually when let's say, for example, I'm a startup, I'm trying to service the traditional guys, and if I can't meet the demand, eventually those clients or stakeholders are not going to come back again because of the fact that, you know, you're not ready. So that could be a bad thing. But if you zoom up towards to how VCs are operating around, like what Dmitry mentioned, you know, we're not investing actively at this point of time, unless these are deals that we've been talking to for the last 1-2 years. We might pull some triggers, but ultimately speaking, I don't think VCs are in a position where we want to make, you know, random bets anymore. It's more of looking at how to enhance the portfolio companies. If, for example, if we're going to make any investment decision, it's going to be because of the fact that this new investee could add value to what we have. So that's my 2 cents.
Thanks, Victor. And so just to close it out, maybe from my side, I actually started as well fundraising my first fund in December 2019. So probably not the easiest year to raise a first fund, and so I've gone through the same issues, I guess, or difficulties that Scott mentioned. I think, however, in a way, we are relatively lucky for a couple of reasons, really. If you think of it, of course, taking outside the COVID impact and indeed families having to focus their assets or their cash to show up the investments or the assets that they own. One is that I think globally the allocation to private equity has increased. So if you look at how portfolio allocations worked before, they'd only be maybe 5 to 10% max for PE. And now because of bonds being an issue and because of markets being at an all-time high, actually a lot of families are increasing their allocation to PE. So that's the first interesting trend that we're seeing. The second trend that we're seeing as well, it's really that Asia is probably the only part of the world where you're going to be seeing any growth for the next 5 years, right? If you think of it, Europe is kind of going to go to the doghouse for at least 5 years. US, as always, will probably rebound. But so anyone looking for growth will probably also increase its portfolio allocation to Asia, over the next 5-10 years. And so I think that's kind of a trend that we've been seeing, although it has come out only in the last 3 months. I think for the first 6 months of this year, everybody just pulled the plug and waited, especially in creating new relationships with new managers. I think from our perspective, our focus is consumer. So that's fast-moving consumer good, education, healthcare, can be tech or non-tech. But the shift that we have seen, of course, is, for a business to be resistant to COVID, it has to be digitally enabled. And so I think that, that trend, COVID has definitely fast-forwarded the digitalization of a number of businesses by at least 3 to 5 years, and that trend will be here to stay. And for portfolio companies, I think, it was a case of if you had raised just before COVID, you were probably in a relatively strong position to be able to make it through. But if you were thinking of raising in March or April and COVID hit, you were really in a dire situation. So what we've seen actually quite surprisingly as well from a company perspective is that as much as before growth was the focus and everybody already said that they were focusing on profitability, the reality is a lot of businesses that we've looked at over the last 2 to 3 years, all of a sudden have improved their margins by 10 points. And, you would have had this discussion pre-COVID, they would have said it's impossible because we're already doing this, we already done that. But then all of a sudden, when they really had to, founders somehow found a way to boost their profitability, their gross margins, and the overall kind of, path to sustainability, path to profitability of the businesses. So I think that's something that from a company perspective, at least from an investor perspective, it's kind of, you've been able to see the founders and the teams that have been able to kind of really focus on profitability and tweak the business model to try and get to profitability faster than they would have before. And so that's something that stood out for us as well over the last 6 months.
It's really interesting. I think a quick follow-up to that, and anyone can feel free to jump in if you have an answer that you think is good, but Victor and I think Scott and a few others mentioned that at this point, you're not really focusing on making bets on companies. It's rather than just supporting the portfolio companies that you have now. My question would be, if you are a startup founder right now and you're looking for funding, what would be your advice? Or is seeking funding even the right thing to do right now if you do have a startup?
Well, I mean, I don't mind going first. I think at this point of time, it's just really bad if you're a startup going out to fundraise, because investors are going to use the fact that liquidity is not there as a reason for you to give a discount on valuation, etc. So from what I know, a lot of the VCs, a lot of portfolio companies that some VCs has backed, they have already given them the second tranche or top up a bit more money for the portfolio companies so that they could last and hopefully outlast the whole crisis, in order to avoid going out there to talk to new investors so that the valuation can be sustained. But of course, for startups that are operating in the essential sectors, this is perhaps the best point of time to actually talk to traditional non-VC type of investors, because they would be more keen to look at new opportunities given the fact that COVID has taught them a lesson that digital is the way forward. So I think as I think the key factor here is on the strategic point of view. From a strategic point of view, there needs to be some sort of synergy with your investors. Talking to financial investors at that point of time, it is really the worst timing there is.
Yeah, I think I agree with Victor on the fact that it's not the best timing to go out fundraising. But what you do see though is that the companies that are performing well in COVID have been receiving crazy valuations, right? And we've seen this across India, across Southeast Asia. The top 10% of companies that have done well for COVID because of, they were in the right vertical, they were in ed tech, they were in health tech, this is on my business, right? They were, a vertical, a D2C, and they've kind of, of course, everybody switched to online and to the digital side, and so they've done extremely well. Those guys are raising at actually higher multiples than before because there's a scarcity now of assets which have that quality aspect and have been able to show growth, increased margins, and increased contribution margins. And so those guys are actually getting crazy valuations. But I would say, if you're not one of those, indeed, but you need capital because it's not a question. If you can delay, you can delay. If you can delay, focus on increasing your runway from 6 to 12 months to ideally 18 to 24 months, or otherwise try to get a bridge financing round from your existing investors who hopefully can put in something at a discount to the next round or whatever, and we've seen that a few times. But for that, of course, you need to have a close relationship with your existing investors.
I'll maybe add a note of cheer to this. First 5-6 months, I think everybody was reassessing and also waiting for the founders' expectations to get to a new balanced state. As of 2 months ago, even 1 month ago, things are definitely picking up. Way too much money has been raised for Southeast Asia, not for every country, not for every vertical, not for every stage, but in places where the money has been raised that now needs to be deployed. So now it's more about operational challenges of investing sight unseen and not being able to do site visits, and people are working it out. So it's not dire, but expectations on valuations obviously need to be adjusted, and the sheer time spent on actually closing the deal, it was never fast in Southeast Asia unless you're in seed. Now it's another 3 months of just, Zoom calls and scheduling and attempts to find local affiliates to help you with on the ground due diligence. So not impossible, just lower valuations, which might actually be healthier for the ecosystem in the long term anyway.
Yeah, I think maybe to give a bit of a seat or maybe round it out, there's definitely a difference between companies that are doing well and the ones that are struggling right now. It's really, I think people talk about a K-shaped recovery. There's a lot of have and have nots in the market right now. And for those who have, the capital is abundant, and those who have not, it's really, really tough going. Also, there's a big difference in stages from what I see in the market. At seed stage, valuation is less sensitive to a lot of things. You may find investors who are a little bit punchier on their valuation, but if you're a hot seed stage company, you've got dollars chasing you all over the place here. And as things go later stage, valuation comes into a much bigger piece of it, right? Because startups are trading at very high multiples of a metric, and when those contract just a little bit, there's it's like a whip effect, and so the destination always determines where you are today. So it's a little bit easier at seed stage, but again, you can be in a hot category. For advice for startups, at least at the seed stage, if you're already down the road, you're down the road. You probably have less options and less easy things for me to tell you. But if you're looking at investors, ask an investor how much they've been investing in the last 6 months. There's some investors that have not invested at all, and there's some investors that have continued to invest. Ask them about reserves, ask them all these kind of tough questions to get an understand if you're really going to be able to get money from them, even if they like you, or if it's going to be sort of you're going to get strung along. Also, I would say bias your, and this is not self-serving, I promise, but bias your efforts towards funds. I think Dmitry mentioned that funds have money, they've raised money, that money has to go out the door. Otherwise they give it back and they don't get paid. So there's a bias to invest money if they've raised it. For family offices, for high net worths, for angels, all of these kind of folks, there's no pressure for them to invest. So just a few things to kind of
And maybe I'll add one more topic here on the topic of seed. Bunch of people, one practical bit of advice is a pretty strong growth recently of networks of angel investors who are professionals employed in large digital companies. There is the ex-Googlers community, there is a strong AWS community, there is a bunch of others. Unlike big family offices, they're not hurting, they're still paid, they still have savings. So they and their friends can always round up a few $100,000 to get someone started. And they're mostly just stuck in Singapore, stir crazy with cabin fever. So now is the time to strike if you're starting something from seed.
Definitely, that's very helpful advice. So I'm going to move now more to your own personal journeys. Every single one of you has started your own VC, and I think this is a dream for a lot of people, but a lot of people have no idea how they could even do that, even if they are MBA students. So I would love to learn more about how each of you ended up doing what you're doing now, and then also maybe talk about what you've learned, what mistakes you might have made, and what you would have done different if you were at NCED right now and your goal was to start a VC at some point in the future. And yeah, I'll start with Nick on this one.
Sure. So I think it really depends if what industry you want to go, or what kind of stage you want to kind of go in, whether you want to go into VC, growth, buyout, more traditional private equity. I think the more you go to larger funds, the more you will need more what kind of a financial background if you want. If you're more in the VC or growth stage, then I think it's interesting for people that have had an experience within an operating company that do an MBA and then can kind of come into those funds. I think the earlier you do the switch, though, the easier it is. So if you wait until you're 37, 38, it might be harder, or then you'll have probably to try and raise your own fund. So my experience of fundraising, and it's the first time I'm doing this, is try and do this with two people. I'm doing it on my own. I'm lucky to have my old boss who's my anchor, and he's on my investment committee. But having two founders just makes it much easier from an investor's perspective, because it's not a concentrated key man risk. So I think that's definitely one thing, and being specialized, I think, is another thing. So I think being able, we're consumer focused. I think it hits, of course, it's a core trend that you're seeing in Asia these days. But I think it makes a lot of sense. Don't try and be a generalist, because otherwise there's already so many people out there. So you've got to try and come up with a thesis that is the right for the right time. But I think coming back to MBA, and if you want to join a fund, these opportunities, as you know, aren't plentiful, and so it's about creating relationships with the people within the funds, whether the founders or the managing directors or whoever at this relatively senior level, and cultivate those relationships over a certain amount of time, because these jobs don't come up through just searches normally, right? It's more kind of something comes up and they've already got someone in mind who would fit well within the role that they're looking for.
Great. How about Victor?
Well, I mean, this is a tough question. Honestly, I don't really encourage anyone else to go start a VC firm at this point of time. But yes, Dmitry, yes, I can see that. I think if you're dumb enough, you are going to start a VC fund. But if you're smart enough, you're going to be a founder, because it's just makes more sense. You're solving the real problems. But if you are thinking about starting a VC firm, this VC fund, the most important part to me, I mean, again, resonating with what Nick mentioned as well, on relationship. So, but the fundamentals of having a good relationship is being someone who's likable, thinking that you're not the smartest guy in the room, being able to solicit support, getting the right people to back you up. It works with fundraising. It works with finding your partners, your GPs. It works with how do you actually get into a good deal as well. So technically speaking, there's nothing much that can prepare you for VC, because ultimately you're going to realize that what you study in CFA, what you're going to study in your finance courses, it wouldn't work, especially for early stage, which is why there were so many bankers, there were so many finance guys who try to do VC, but it just doesn't work. I think it's more of a mental state than what kind of skill that you need. But bottom line, if you're thinking of starting a VC because it looks cool and glamorous, forget about it. It's just too much things that you need to handle. You're running like a startup as well. You can't forget that a VC is also a startup in at least the first fund.
And just to add to Victor's point, sorry to dodge back in, but I think you said something very true, right? Is that it's easier to start a business in a way and to have some numbers to show, because then the people aren't looking just at you, they're looking at actual numbers. If you're starting a first-time fund, they have nothing to do but look at you, and you probably don't have a track record, right? So I wouldn't even start trying to fundraise unless you've been able to secure an anchor investor, which is meaningful, and I mean by that at least 10-20% of the size of the fund, because otherwise you're just going to spend 6 months running around and you're not going to get anywhere. So I think unless you have those relationships, with that ability to get a first anchor investor, it's going to be really tough down the line. And I agree with Victor, just there's so many opportunities in Asia today to actually launch your own business that it might actually be an easier road.
Maybe it's a good, I think first thing to keep in mind is that VC is a get rich slow kind of business. It's not a get rich quick business. You make a lot more money working at Amazon for a few years than starting your own VC. A few numbers to I don't want to crush anyone's dreams, but average first-time VC, I think it takes 18 to 24 months to close their first fund. That's a first close, not a final close, and there's a lot of survivorship bias in that stat. So you can imagine it's not necessarily easy to do. For somebody who wants to get into venture capital investing, I think there's a few paths into it, or a few common paths into it. I would say stay away from the finance track. I say that as somebody who's got a finance background primarily. Maybe marketing or sales is probably the easier one, or if you're really good at product, you're a product person. Those are probably the top three that I would look for. Or tech. You want to put tech in with product, the two different things, but something along that. I mean, you're looking at businesses. You're looking at businesses for the business value. There's no numbers to crunch. There's no spreadsheets to make. All the math can be done in the back of an envelope, especially at seed stage. It's really about what's going to drive value to a business. So what would be the best track to go into? Probably would be to work at a good startup. The easiest track would be work at a good startup. Try to work your way into a senior position there. Maybe talk to a few VCs, build some relationships there. If you're not on that side of things, if you're not that senior, or start networking with VCs. If you're a great product person or a great marketing person, sharing your insights and the way you think. Maybe you get a role as a venture partner. Maybe they start to use you as a talent tool, where they start plugging you in to startups that they work at, and you can kind of see the game from that angle. Those skills are going to be much more valuable than just sort of studying a bunch of CFA books, for sure. If that was your plan A, I guess.
It makes a lot of sense. Then finally, Dmitry.
Sure. So I was asked to provide practical advice, so I'll skip the part where you're thinking whether to get into VC. I assume you already doomed yourself to that. And I will not comment on anything outside of Southeast Asia, not my speed. Within Southeast Asia, I can say from practice of last 9 years that introductions from portfolio companies matter. And that's not just the case of our firm, but just about every firm with which we interact. So before starting a fund of your own, unless you're blessed with a benign anchor, worth getting a couple of years worth of market intelligence on key names, key schools of thought, key moving drivers of the ecosystem. And for that, joining a functioning VC firm is a good idea. And how to join a functioning VC firm? Easy. Find 3-4 treasured top performing portfolio companies of theirs and be extremely useful to their founders. Founders are always in need of hands, brains, eyes, advice, free labor. If they can be induced to make a solid, warm introduction to a VC firm that backed them, saying, well, this guy, he volunteered free labor straight out of INSEAD, helped with this, we engaged him on that project, he helped with that, he was good, he showed up on time. That would be a pretty solid start of a conversation with a VC firm. It might take a while because not every founder responds to his LinkedIn messages, but eventually I would strongly recommend that route. And a little bit of personal angel investment on the side. And if you do not have money to do that, then joining one of those professional networks, whether they're ex-INSEADers or ex-Googlers, and being functional in that community. But it's a secondary move. Primary move is approach through valuable portfolio, engage venture firms, get all the data they have for a couple of years, then launch your own. If Anchor is not available, then launch on somebody's platform. So many global platforms that are kind of curious about Southeast Asia, but have not yet gathered the strength of will to set up an office in Singapore. So become their office in Singapore. And in a few years, you can take their brand and their capital and hang your own shingle, as it were. Mercenary, but works.
Great. And so we have a question for the audience, from the audience for Scott, and I think it also applies to Dmitry's point, which is he asks, when you say work for a good startup, are you referring to early stage or Series B plus startups?
It probably is going to be a later stage would help you the most. If you're at a very early stage, I think if you're anywhere in that like seed, you should be really working you should go for that ESOP and try to build a big company, right? But I guess it's a little bit more along the lines of what Dmitry also just said, which is, you know, show some value, make a name for yourself with I guess it kind of circles back to a lot of the themes that everyone's been mentioning is relationships and reputation. You're going to get that by being a sort of shrewd operator. Maybe shrewd's not the right word, but a very good operator. That's what's going to drive your reputation. And networking amongst founders and getting your name well regarded amongst founders. You can extend that to the VCs that invest. So by a good startup, if you've got a startup that's backed by 3 or 4 big name funds, start to build relationships in there. Show them deals that are your friends that you know because you've got relationships in the startup ecosystem, and you say, look, this company has got 3 talented people in it and they're a little bit flying under the radar. Show it to a seed person, or show it to the Series A guy and say, look, this guy's took some seed money and they're hitting it out of the park. They're blowing out their numbers, you know, and start to build those relationships, and you'll start to build trust within a VC. Probably if you're looking to join a VC, it's going to be one of the larger ones, most likely, but that has a little bit more room. If you look at small VCs like mine, we don't really take on a lot of we don't have the machine, you know. It's not where we are today. Maybe in 10 years we might be there, but so unless a partner dies, you're not going to be a partner in the next 3 or 5 years, which is, I hope, not too. We got another one in here too. I think, Michael can also speak to these topics.
Yeah, he'll be coming on next. So it looks like our time is running out. So I'll just ask one very last rapid fire question before switching over. As this is the Emerging Markets Club, we like to focus on different emerging markets and figure out, you know, which are the best places to invest. So my question for each one of you will be, if you had to choose one country in Southeast Asia to invest in, which one would it be? And I can go first.
You see me? I'm sorry.
Yeah, sorry, I guess there was a lot.
I'm gonna go on a limb here.
I was saying Indonesia. Can go first. Yeah.
Yeah. Scott, were you going first?
I said I would go on a limb and say Indonesia would be the one in Southeast Asia.
Okay, yeah, I think for me, I'm a slightly later stage investor, right? I guess than everyone here. So you know, we come in, we're a growth investor. Yeah, in Southeast Asia, it'd be Indonesia, but I guess between Southeast Asia and India, it would still be India today. It's just more mature as a market.
Well, I can go next. If I were to choose personally, I would like to be in Vietnam.
Great choice. And Nick can close it out.
Dmitry, do you still need Dimitri's?
I think Nick went with India. I'll go with a minority of opinion that I really don't like single country risk on any of the nations in Southeast Asia. They're all pretty tricky.
Yeah.
Every
Agreed.
5 years, they lob a grenade your way and you really regret your life choices. So in that spirit, I would say Malaysia, because that country produced most of the regional story in Southeast Asia, according to our research. So by betting on Malaysian ecosystem, not too early, you have a reasonably good chance of ending up a shareholder in a company that has its risks spread across the region. And that way I craftily work around the moderator's question.
Wonderful answer. So yeah, this was very interesting, and I'm sure we could go on for a lot longer and there would be a lot of questions, but unfortunately our time is short. So we'll move on to the next discussion, which is also focusing on venture capital, mostly in the same region.